Good afternoon. This is Chris Brecher with the Simpler Central Room, Simpler Chart Patterns Mastery Room, and Simpler Trading as a whole. Just a little synopsis of what it means when the Fed cut the rates 50 basis points. Well, keep in mind a bunch of things in here, but this is number one. This graphic that somebody else was nice enough to post on Twitter. The S&P is up 19% in the first 182 trading days of 2024. The 17th best start to a year going back 1928. Now you might ask, what the heck does that have to do with the Fed cutting rates? It's because they've anticipated that rate cut now for the entire year. So just keep that in mind. That's number one. It's already gone up in anticipation of this. So that's number one. Number two is what happened in 2019. And you'll go back to this. What happened in 2019, the first 182 days? Yep, 19 is right in here, was way up. So if you look in here, 2019 was up most of the year. It's down under here. So just to let you know, it's down under here, but it's way up. And the key in there is what happened after the Fed cut. I'm not talking about cutting in April or June or anything. I'm talking about in this historically weak time. And when the Fed cut in 2019, the stock market went down a lot. So it went down about 200 points. So that's about 6%. That's at that historically weak level. Keep in mind, it rallied in anticipation of that cut. Now, when they cut back here, yeah, the markets continued up. But I just wanted to show you that in a historically weak time, this is what can happen. Now, one of the reasons that happened is also because of lack of buybacks. Companies voluntarily don't buy back stock in 5 weeks prior to earnings. So that time comes out to this area. It comes out in this area between September 10th and about when Apple's earnings are, which is right here about October 1st, about November 1st. So in that window, it doesn't mean stocks can't go up. It means they're less likely to explode on good news because companies can't prop up the stocks. They still can go up, but this is why this time is historically weak. Now, the next thing you might want to know, and it's a legitimate question, shopping, credit cards, bond market. What happens when the Fed cuts? Well, the first thing to notice is the long bond, the 30-year bond, has gone down every single day since they cut. Every single day it's gone down. That's a big move. That's 3 points. Why? Because if they cut, believe it or not, that means it's more inflationary. Especially when they cut and say that it's not like because they think there's a depression. That's the other thing. When the Fed has cut in the past, usually markets eventually go up. When the Fed cuts because they're worried about a depression, like 2000, 2008, stock markets go down because they get nervous. So most of the time, all things considered, the stock markets go up after the September historical weak time. But as you see, the bond market went down. Now you might say, okay, that's a 30-year bond. How about the 10-year note? What has the 10-year note done? Well, that's a good question. So you go and put the ZN. That's a 10-year note future. It's gone down every day since the Fed. Yeah, it went up all year in anticipation of the Fed. So right now, what does a 0.5 basis point move mean to me? Does it make mortgage rates go down? No. As you see, mortgage rates have gone down. A lot of 30-year are based on the 10-year note. And when this rallied, mortgage rates went down. Now mortgage rates are doing nothing. just doing nothing. It's just been a non-event. So just keep that in mind, a non-event. Now, how about credit card stocks? They've done nothing since the Fed. They rallied into the Fed. How about shopping stocks? Well, Walmart's gone nuts. Home Depot rallied into the Fed and now has done nothing. So usually the 0.5 does make a difference eventually in the stock market after buybacks can resume, basically in earnest November 1st. That's historically an extremely strong time in the markets. So just keep that in mind. The other thing in here is going to be how much more they cut. So how do you know? Well, the first thing to do is to see on how it's affecting commodities. So like I said, the bond market's gone down because in a way it's potentially inflationary. I go on 3 inflation gauges. I go on the Dow Jones Commodity Index. As you see, it's gone straight up since the Fed. Straight up. The Fed is watching this. How about the Dow Jones, the Invesco Agricultural Fund ETF? Well, that's almost at a new high. This is the one that doesn't include oil, but includes agriculture. The oil one has had a heck of a rally too. What does this mean? It means that the Fed is less likely to lower more rates if this really has more of a rally. When does it start mattering? Well, the reason that I use the DJCI is because it's more expensive. It's just more volatile. That's all. So what does the Fed care about? They're going to care if the Dow Jones Commodity Index gets above this level. If it gets over that level, they're going to have to reassess what they said about inflation being calm. That basket is then a big deal. Also, keep in mind another thing election-wise. If you see this basket explode for the next month, that is not going to help sentiment of people that are going to vote with their pocketbook. So if this commodity index gets up to this zone, that can also have political implications. So the whole moral of the story is that the Fed definitely helps, but if this goes up enough, I don't think you're going to see the Fed cut as much as you think in the future. Hope that helps. Have a great rest of your day and take care. Good afternoon, everyone. This is Chris Brecher, and I'm Senior Managing Director of Stocks at Simpler Trading. Thanks so much for watching this video. If you like our content, please leave us a like and a comment down below. Also, be sure to subscribe to our channel and click the bell notification icon so you never miss any of our great new content coming out. Good trading, and we'll see you at the next video. Take care.